Tax systems have a profound effect on the political, economic, social, technological and environmental landscape, both today and for the future. It is therefore important that the tax system changes over time to adapt and align with developments in these areas. Consider the situation where governments rely on fuel excise and car registrations to fund road infrastructure. With the development and mass take-up of fuel-efficient cars, electric cars and ride-sharing services, the revenues from these forms of taxes are going to fall considerably. This highlights a complex issue about whether the government will support such developments and how it will continue to fund the road infrastructure. A range of factors will need to be considered, including political ramifications, productivity and economic growth, as well as environmental concerns. Options include taxing road users based on the distance travelled, or the areas or zones travelled to, such as congestion taxes. Tax systems are designed to generate revenues from private taxpayers to the government. The revenues are used to fund a wide range of government programs and public goods, as well as for income redistribution. But how do we know whether the tax system is performing well or meeting its objectives? We need a framework for assessing the performance of the tax system against its objectives. 4 key principles for evaluating the tax system are fiscal adequacy, equity, efficiency, and simplicity. Fiscal adequacy refers to the government's ability to meet revenue needs. That is, the sources of tax revenue need to be sufficient to enable the government to deliver its planned programs and fund its expenditures. Keep in mind that changing economic conditions can affect the source and amount of these tax revenues, so it's important for the tax system to be able to withstand these changing circumstances. Equity refers to fairness in the distribution of the tax burden across the population. It is primarily based on the taxpayer's ability to pay. Vertical equity demands that taxpayers on higher incomes pay more tax. Horizontal equity demands that taxpayers on similar incomes pay the same tax. Another element is the beneficiary principle, where the tax burden is borne by taxpayers who benefit from the government service or program. Efficiency refers to how productive the tax system is at raising revenues and redistributing wealth. We want to make sure that resources are used in the most productive and value-adding way. In addition, efficiency refers to the relative transaction costs that are incurred by taxpayers. These transaction costs refer to how the system alters the taxpayers' incentives and behaviours, such as how hard they work, as well as the taxpayers' compliance and administrative costs, such as record keeping and submitting returns. Simplicity refers to how easy it is for taxpayers to understand their obligations and entitlements, and how simple it is for taxpayers to comply with laws and regulations. Technology improvements, such as data matching and online submissions, as well as different communication methods to educate and inform taxpayers, continue to provide strong opportunities for simplification of the tax system. It's unlikely that a tax system can achieve perfection in each of these 4 core principles. As such, trade-offs are likely to be required, such as balancing efficiency and growth with distributional outcomes of equity. This will require an assessment of the relative weighting or importance of each principle, taking into consideration a range of environmental factors for both the current and future landscape.